because GCS are one of our best Canadian partners, so I'm delighted to support GCS in this event. Kevin actually kicked off the event by talking, he talked about an IoD Institute Directors event that he went to in the UK, where they talked about innovate or die. Well, I think one of the themes that we've seen today already in every session this morning is about change. Whether it's changing economic circumstances, or changing credit risk, or changes in consumer demand and reactions. And in fact, I thought that Simone put it very well. She said, new market realities, new consumer demands, and new challenges. And I think that means for us new responses. And I think in this little session where I'm going to talk about international trends in debt purchase and sale is also about change and about innovation. So I hope you'll get a sense of that. Okay, let me start by giving you a little bit of context, because I think it's important that you know the context from where I come in this conversation. Okay, so Active Capital was formed in about 1991, and we've been buying non-performing consumer debt since that time. We currently have about 7 million customers, that is debtors, people who we deal with to try and get their debts paid off. We operate in 10 countries in terms of having in-house operations, and we have activities in 13 countries. And those countries are Canada, UK, Spain, Germany, Austria, Switzerland, and all the Nordic countries, so Denmark, Sweden, Finland, and Norway. And then we have activities also in Portugal, Italy, and a couple of other countries like France. So the experience that you're going to get is very much a Western Europe experience, and trends that we've seen over a period of time that we've been operating in those markets. Now what we have is both in-house collections and we use agencies as partners. So we see both sides of the fence. Roughly we spend about 150 million euros per annum on debt purchase, and we buy on occasions up to about 5 billion euros of face value every year. And finally, we're a publicly quoted company in the Norwegian Stock Exchange. So that's the background from which this presentation comes and my experience comes. And I want to start by just explaining that although all those countries that I talked about are what I would call, or I think what we'd all call are pretty developed countries, the environments in those countries are completely different. So I've got two extremes here. I've got Sweden and I've got Spain. So our Swedish business has a lot of benefits. First of all, we know where every customer lives. We know how much every customer earns. Now that's pretty good, isn't it? We have every single piece of documentation on the debt that they took out. We have a terrific legal system in Sweden, whereby literally within a matter of weeks, we can ask bailiffs to go in and seize assets. We have a stable economy, and there is absolutely no such thing as time borrowing of debt. Okay, you take out debt in Sweden, you're going to be paying it back. Okay? And in that marketplace, payment plans are 90% of our revenue. We only generate new business. 10% of our business every month is generating new. Now the contrast with Spain is quite stark. In Spain, we have no data. We only have block data, so we only have negative data about how customers are performing on debt. 30 to 40% of the minimum of our customers are non-traceable, are in our trace queues. We have very little documentation. It is a major issue for us if a customer wants us to prove the debt. The legal system in Spain, I was talking to somebody a little bit earlier on about the legal system in Spain, and I think it was Kevin actually, and the legal system in Spain, if you start going through that process, you have no idea when it is going to be worked through, or even what the results are going to be. The economy there, we know, has had a disaster in the last couple of years. It's up to 22% unemployment. I find that a really staggering statistic. 1 in 5 are unemployed in Spain. I know a number of those people will be in the black economy, but still. the business that we have there is very, very different. So payment plans, where there were 90% of our revenue, monthly revenue in Sweden, are only 20% or less. And 2% of our customers represent more than 30% of our monthly revenues in deals. Now, what does that mean? That means that despite we're talking about pretty developed economies in each of these markets, the attitudes, the consumer attitudes, the attitudes of sellers are completely different. The drivers are completely different. And the strategies we have to adopt are completely different. Does that make sense? Yeah. I didn't understand this until I came into the industry, and I found it quite fascinating.
Welcome to the Middle East.
Thank you. We haven't quite got there yet. Maybe next.
It's probably worse than Spain.
Probably. Well, we need different strategies again. Now, I love this graph, okay? Why do I love this graph? Because it's really complicated and nobody understands it. Okay? The reality is, and I'll simplify it, the reality is, what we've had change in the last few years. Okay? We had and these are general trends, because as I said, all those economies and all those markets are different. The general trend was that from 2004 to 2008, we had 4 years of boom in debt purchase. The economies were going strong, credit lending was growing strong, debt purchase was growing strong. Anybody was coming into the market, buying, securitizing, and farming it out to agencies to collect. It was a year of that. You did not have to be particularly good at debt collection or understanding debt purchase to make money in those times. It all changed in 2008. Collectability went down, and I'm going to talk about that in a minute. This is a highly risky business, and when collectability goes down, the economics change completely. But also, the sellers, their markets changed completely. So from sale, they had so much going on with the credit crunch and reorganisations in banks and all those other sorts of things, that actually debt sale went off their radars, off their lists. For them, it all became about reputation management, and they didn't want this complication of debt sale. They had lots of other things to sort out. Financing reduced, demand reduced. A lot of the American banks that were buying these assets went out of the marketplace, and prices collapsed because collectability went down. So it became far less attractive to sell portfolios in that marketplace, and so volumes went down. So what did we do as collectors? Well, our strategy was, how do we improve collections in that time? How do we get so good at collections that when the market turned, we were going to be a much, much better business, able to add more value to this marketplace? And that's what we did. And now we're seeing change. So we've seen some of the economic statistics, and the economies are picking up. The banks are sorting themselves out. The markets are much more stable. And debt sale or debt purchase is going up too. And now we're in a strong position, having invested in our operational performance, to really take advantage of that position and also add greater value to the industry. So that's where we are at the moment. But it is very much a selective time for investment. There are still poor assets out there. There are still, and now there are increasing numbers as the market has improved, people wanting to buy. And there has been pent-up demand too. So it's very much about selectivity. Okay. So that's the economic background. What's really been happening? Okay. The volume of consumer non-performing loans has continued to increase. It may be stabilising now, but it has absolutely continued to increase. So last year, in the top 5 markets in Europe, it went up by 45%. Interestingly, I've got the numbers there. Germany went up by 49%. UK by 45%. Spain by only 28%. Basically, lending has stopped a little while ago. Italy 40%, and Russia 120%. So the volume of NPLs continue to increase. Provisions continue to increase as well. Not by much. The big provision hits were taken the year before, but provisions continue to increase in originators. And so what we have now is we have a huge overhang of non-performing loans out there, waiting to be acted on in some way, either dealt with in-house or sold. And those strategies are dependent on the individual originator and dependent on the marketplace. The issue is, what are we going to do about these growing NPLs? Actually, at the moment, there are still very few transactions, or much less transactions, much fewer transactions, than there were at the height, at the end of 2007 and in the first half of 2008. Now, this is a little bit of an old slide because this is our pipeline in the UK, and the bar chart on the right is only to the end of April 2010. So actually, if I took the pipeline now, it is significantly in advance of 2009 in terms of the market purchase opportunities we've got. And this trend is reflected in all our other markets as well. But it's still not up to the 2008 numbers. Why is this happening? Well, prices are recovering. Provision levels are high, but prices are catching up to the provision levels. And demand is increasing. But banks are also sorting out what they're doing internally, and they're getting on to their later priorities. They've organised themselves in the things that they have to do in terms of restructuring, etc. And so now this is coming back on the agenda. So there are definitely signs of life, and we are definitely buying more now. We've always had the capability to buy, but we're now being able to do deals, which is great news. But I think this is absolutely the key, and I'm sorry it's not a great chart, because trying to get information on collectability that I can share with you from an external source is quite difficult. So this is a company called Heuristics, which is an analyst business in the UK, which looked at the impact of the economy on collectability. And that's one half of it is the impact of the economy. The second half is what you can do as a business. But the first half is what's the impact of the economy. And what it showed was, in the economic downturn, settlement deals with consumers, the amount of money you got from settlements, fell by 40% on equivalent debt, which is a staggering number. But payment plans also went down by 20%. Now you think of the impact that can have, 20 to 40% reductions in collectability, the impact that has on your operational metrics and on your profitability as a business. It has a significant impact. I'll talk about that in a little while. But it's actually even worse in our sort of business. Debt purchase is tertiary debt collection. Debt purchase happens 2 or 3 years after a customer stopped paying, because it's been worked by an agency or 3 before it's sold. So you imagine, in a poor economy, a customer hasn't paid for 2 or 3 years, confidence is low, the consumer thinks, is probably thinking, worried about his or her job. What are the prospects of them paying now? They're much lower, aren't they? Yeah? That's the environment we've been in.